Hi everybody, this is Karen Highland with the Highland Group. Together with my husband Chris and our son Brandon Highland, we are real estate agents in Central Maryland. And this is part of a series of videos that we're going to be doing concerning your credit score. And today we have with us Blair Warner, who is the founder and credit specialist at Upgrade My Credit. So Blair, why don't you tell us a little bit about yourself and your business?
Well, you already said my title. I am the founder and senior credit consultant, credit specialist, whatever you want to call me, related to helping people who have credit problems and debt problems. And the reason you and I are talking is because 80% of my clients, the reason they come to me is because they want to buy a house. That's the biggest purchase and the biggest motivator for someone to get their credit in shape. And I come from a mortgage background, so I pretty much have had my hands in various parts of the whole real estate industry, and I'm just glad to be here and work with people like you to help your clients, more of your clients, get into homes. So, okay.
Great, great. Well, as a matter of fact, today we're going to be talking about credit myths. And I did a little internet search recently and was bombarded with there's a lot of myths out there that are perpetrated over and over again. So I wanted to talk to you about it today, some of these things that I see and hear. And the first one is the kind of thought that a person has that, well, I pay cash for everything, I don't even use credit, so my credit score is going to be fine. What would you say about that?
Well, I mean, of course, that is a myth or some misconception. You know, there's a lot of teaching out there, and I won't say his name, but probably a particular name comes to people's mind. But there's a lot of teaching out there that is telling everybody just pay cash for everything. And it would be nice, to be honest with you, if we were able in a society to do that and pay cash. But that's not the way our society is built on right now. And I'm not against credit at all. Of course, I'm in the credit industry, but the responsible use of debt and credit is really what we should be looking at, rather than telling everybody to pay cash for everything and not worry about credit. But there's still some items that you just have to have a credit score for. I mean, if you want to buy a house, you can't buy a house without credit. Most of the time, people, their first car or two, they're going to need credit. Now, there are people, by the time I got into my 30s, all my cars since then I've been able to buy for cash. But my first couple cars, I had to buy with a loan. And the catch-22 is that you can't get credit without credit. You know what I mean? You have to have some credit, but to get more credit. And so when you go in and you get ready to buy a house, if you don't have any credit, then you're not going to be able to buy a house. And you can't start overnight. Credit is something you have to build up gradually. So if you've been paying cash all these years and you haven't done any credit, and then you want to buy a house, it's going to be another 2 or 3 years before, if you're starting from zero, it's going to be a 2 or 3 year process before you're going to be able to buy a house and have a good enough credit score to do that. So, and the definition of credit is, of course, borrowing money and paying it back. And so if you pay cash for everything and you're not borrowing money, you're not building up a credit score.
Right, good. All right, another question that I have. A lot of people think having lower credit limits on their credit accounts is a good thing. It'll keep them from spending as much, and it doesn't matter to their credit score.
Oh, that's a very good question. And it would be, I don't even know if I could have answered that years ago before I got in the whole mortgage credit industry. But because, again, there's a difference between debt management and then, building your credit score and building your credit profile. If you have a problem spending credit cards and overspending, and you need some sort of self-imposed control over your, using credit cards, and you're not wanting to buy a house or a car at any time, in the near future, then yeah, I mean, it would be okay to lower your limits so that you've put that sort of self-imposed control on your spending habits. But that's not going to help you build your credit as well as if you have higher limits and then just use a smaller portion of those higher limits. So if you are the type person that has self-control it would be better to have a $5,000 credit card and never go over 1,000 or two on your spending balance than to have a 2,000 limit credit card because you're trying to curtail your spending, but yet you always max it out to 2,000. Because what FICO is going to look at is a ratio of your available limit and how much you've used of that each month. And so the higher you have, of course, it's easier for you to stay at a lower ratio.
Right. Yeah, so self-control has still got to fit in there.
Yeah, it's got to fit in there.
Look at it.
Well, and see, lenders like that because they want to know that you have self-control. I mean, if you're getting ready to buy a house and someone's going to loan you $150,000, to buy a house, and I'm in Texas, so that'll buy a good house. But
yeah, they'll buy a condo, maybe.
Yeah, there you go. But they're getting ready to lend you a lot of money to buy a house. They want to know that you have self-control. So yeah, self-control's always got to be in there.
Right. Right. Okay. Then what about? I've always been able to get credit whenever I wanted, so my credit should be good.
That's something that could come back to bite you, that kind of thinking. First of all, if you haven't checked your credit in a while and you don't know what it looks like, let's say it's been a year or 2 years or 3 years since you've done anything on credit, and you just think that your credit score is the same as it was 2 or 3 years ago, but yet you haven't checked it, chances are it's probably not. Because, first of all, there can be errors on credit reports. We all know that. It's a big national, issue right now with even in legislation, certain legislation about how our credit system is crippled and doesn't there's flaws in it, and so errors can be reported. Second of all, sometimes we think we made a payment on time and we didn't. I've had people come to me that said, they made their payment on the 29th. And it was due the 1st, or they made their payment, whatever, and they thought that it was going to get there in time, but by the time it got recorded, it was recorded late. Well, if that was a year ago when that happened, and you haven't monitored your credit score, how are you going to know that until you check your credit, and that would have caused your score to go down. And so your score is not going to always be high just because you used to get credit in the past. You have to stay on top of it and watch it.
All right. Now, are some lines of credit easier to get than others? Could that be part of the equation?
Yeah, there is. You're right. I would say that probably, credit cards are high interest rate credit cards are easier to get than low interest rate credit cards. And so, someone might go and apply for a card and they get accepted, but it's a higher interest rate. Auto loans are easier to get than credit cards, so you might think you have a score in the 700s, but really to get an auto loan, all you got to have is about 620 or above at most dealerships, and 620 is not considered a great score. It's just kind of a so-so score. So in fact, that came up the other day. Someone said, I don't know why my score I didn't get approved for a mortgage. Just a couple months ago, I went in and said I wanted that car, and I got approved and drove out of the parking lot with a car. How come I can't get a mortgage? And I said, well, because their criteria, is different than a mortgage. So that's a very good question. Yeah.
Well, and as you say that, I'm thinking a car is a lot easier to repossess than a house.
Yes,
so,
that's right. Absolutely.
Hence the standards.
That's right. Very good point. Yeah.
Okay, so what about, you hear this a lot. I need to raise my credit score, so I'm going to cancel a bunch of my credit lines and my credit cards.
Oh, yeah. That, in fact, people, not only do you hear that a lot, people actually do that a lot. Mm-hmm. And a lot of people go out and start cutting up their credit cards after listening to certain seminars and certain speakers. And let me tell you, I'll tell you very clearly why you don't want to do that. One of the factors of FICO, FICO, everybody knows FICO is the company that makes the most popular credit score. There's a couple other scores out there, but the one that most lenders use is FICO. And maybe you haven't thought about it, but FICO has this elaborate algorithm, this calculation that they use. They put all your data in and all your history and all these different things, and pop, this score comes out. And what that algorithm includes is, we don't know everything at all what it includes. It's kind of in lock and key somewhere in the corporate headquarters of FICO. But we do know some of the main things that involves in their calculation. And one of the things that they look at is how long you've had credit. That's why you'll find somebody that's 50 years old with an 800 score and somebody that's 23 years old with just a 620 or something, because they're going to look at how long you've had credit in general, and then they're also going to look at how long each item or each trade line has been open. So if you have a credit card that you got 20 years ago and you're still using the exact same card with the same number, nothing's changed, that's going to help your score, boost your score more than if you just have a bunch of new cards that you just got in the last couple of years. So what happens if you go start cutting up a bunch of cards and you cut up the wrong ones? You cut up the older ones. You've taken away that history. Now when FICO runs your score again in the next cycle for next month, it's going to cause your score to drop, and it'll drop pretty drastically if you cut up several cards at once. So you don't want to do that. And if you do think you have too many cards and you went on a card frenzy and got all these 7 or 8 different credit cards, there is a strategic way of doing it, and it would be something that I would give some advice like that for free. So be careful about that.
Okay. Well, good. So what about the opposite extreme? I can never cut up a card ever again.
Yeah, that's true. That's the opposite extreme, and some advice that I would give to people, because that's also a myth. It's okay if you have 7 credit cards, and you just say, I'm tired of carrying so many, or I'm tired of having so many cards that I have to worry about and stuff. Then you could go ahead and eliminate a couple of those. I still think somewhere between 2 and 5 lines of credit is really, you need to maintain 2 to 5 lines of credit. 2 is a minimum, 5 is probably just about right. So let's say you have 7 or 8 and you want to get rid of 2 or 3 of them. Then you got to go in there and you got to look at the newest ones. And some people will go in there and will close out the ones with the highest interest rates. But what if the ones with the highest interest rates are the ones you've had longer? Then that's not going to help your score. It's going to make your score go down. So I would go in there and close out the ones that are the newest, the youngest credit cards. You're absolutely right.
Okay, good. Well, good advice. All right then. Next question.
Okay.
Consolidating my credit will help raise my score.
It's another big problem. The things that a lot of people do, and again, it's funny how we keep kind of going back to this same scenario. But again, loan consolidation could be good in certain situations for debt management, but not for credit score boosting or credit score management. I know that there are people who may not have the same level of self-discipline, and it would be easier for them just to make one payment, on one consolidated loan every month, than to make 7 payments, to 7 different accounts. And for debt management purposes, I can see that. However, you're running into the same situation that if you start consolidating loans, what are you going to do? What's going to happen to those 7 old loans when you consolidate into one? You're closing them out. And what if some of those have longer history? So now you've lost all that history, and FICO just sees one loan, and it's a new loan, a current loan, and it's no longer calculating in that history of the older loans. And so you're losing that. Now, I'm not saying that's bad. I don't want to give that impression. If you're not going to buy a house for the next couple of years or a car, and you're not going to do anything on credit, and you really think you need to consolidate to lower your interest rate and to help your debt management, it can be a positive thing to do. And then you got a couple years to build up your credit score again. But don't do that if you're going to buy a house in the next 12 months.
Right. So it depends on your goals.
Yeah, it really does depend on your goals. Yeah.
And there are different goals that don't always line up with best credit score, and vice versa. I can see that.
And I'm glad that we're addressing this, because we don't want to give the impression, since you're in real estate and I'm in credit repair, that we don't care about people's bigger goals and the bigger picture. And we do. And so again, if we know their goals, if you know their goals, we'll be able to advise them accordingly. There's no set cookie cutter. That's why these are myths. That's why actually a lot of these are called myths, because every myth has a little bit of truth in it, if you ever thought about it. And so, there's some truth in it, but you have to depend on the person's goals and circumstances.
Right. Good. Good. Okay. Here's one that I personally, maybe it's my personal favorite. We just got approved for a mortgage, so I'm going to go out and charge up my furniture, get a new car, etc., etc. Sorry, my hand's right in front of my face.
Yeah, go out and get new furniture, figure out how they're going to paint the house, or, sometimes they get new appliances, all kinds of stuff. Well, the problem you're going to run into, and that's what a lot of people do, is that just because you were pre-approved, when you were pre-approved, it was pre-approved and it has a date on it. So, if you were pre-approved on November 1st, then that was pre-approval for that date. Now, more than likely, nothing would happen, say, in 30 days. But what if you don't find the house? You see, the average person goes out, gets pre-approved, and they start looking for houses. What if they don't find a house for 60 days? Well, then in that 60 days, one, your credit score could change, and could go up or down. And most lenders are going to probably pull your credit again. So between between pre-approval and the time you put a contract on the house, you're probably going to get your score, pulled again. But then it could be pulled another time, which sounds kind of funny because you don't really want to pull credits a lot, but since it's with the same mortgage company and all within a certain period of time, it's not that bad. But then it could pull it again between the time you put a contract on the house and closing, because right now a lot of the lenders, a couple days before closing, they'll pull it again just to make sure that nothing's changed on your credit report, and then if it's gone down, they'll kick it out. So like with an FHA loan, it's the typical standard is to have a 640 credit score. If between pre-approval, getting a contract, and then actual closing, it goes down 1 point to even a 639, it could be kicked out. So during that time, you have to be very, very careful about your credit score, and don't do anything new on credit, because every time you apply for credit, it could affect your score, and every time credit is granted to you, your score is going to go down. Okay? Yeah, it's always going to go down, because FICO says, "Oop, they got new debt. We got to recalculate their score," and that could make your score go down a little bit from getting new debt. So you got to be careful.
Right. Along those lines, there are a lot of myths about checking your credit score, inquiries, other companies making inquiries. What's the general truth about that?
Yeah, in fact, that's probably one of the biggest issues that there's myths around, is because people have this idea. Again, I wouldn't know this either if I wasn't in the business, and that's why there's myths, because you can't trust everything you read on the internet that's out there. It's not the way the whole inquiry thing works. It's not sort of a tit for tat thing. So FICO doesn't have somewhere in their algorithm, every time they pull credit, whoop, score just went down 5 points. Pull it again, up, score went down another 5 points. It doesn't work like that, okay? The way the whole inquiry thing works is, one, it depends on whether it's a lender pull or a consumer pull. If you pulled your credit yourself, like at freecreditreport.com or some of those online places, that's a consumer pull, and also sometimes called a soft pull. And that does not affect your score at all. It's not even recorded as an inquiry. It's only when you're actually applying for credit, like at a car dealership or a department store or a credit card or mortgage, only when a lender pulls it is it counted as an inquiry. But it doesn't even stop there. FICO doesn't care if you pull your credit every now and then. They know that that's going to happen. So they don't ding you every time you pull your credit. What they look at is how many times you pulled your credit in a 12-month period of time. Okay? And particularly if one weekend you went car shopping and you pulled your credit 10 times at 10 different dealerships, that's the kind of stuff they look at. It's not just pulled your credit, score went down, pulled your credit, score went down. So in their algorithm, they're going to look and say they pulled credit the last eight times in the last 4 months. Something's up. Either they're desperate, they're out of money, they need to borrow money to make ends meet, or how do we know that they didn't get credit granted to them each time they pulled? So FICO has to factor in kind of an unknown, that when there was an application, was there actually credit granted or not? That's not being reported yet. So that's how they factor in that unknown as they look at how many inquiries you've had over a short period of time. So that's all the people that are listening that are here because you want to buy a house, I got to tell you, don't not go pull your get your credit pulled because you're worried about lowering your score, because most realtors will not want to show you a bunch of houses until they know you're pre-approved, and you can't be pre-approved till you pull your credit.
Right, right. I mean, yeah, there's so many things about pre-approval that just make such a difference that, yeah, we always do encourage people to have that pre-approval, to have the letter from the lender so that when you do go find a house and you make an offer, they take you seriously.
Right.
Otherwise, yeah, this seller's not really going to be taking you seriously. Okay, along those lines, there's also this idea that about more employers are pulling credit reports. Now, what's the truth with that? Is it illegal, or can an employer pull a credit report? What surrounds that whole issue?
You know, that's a really good question, and in general, yes, employers can pull your credit. However, and I'm not 100% sure on this, but I think there are certain industries that can pull your credit without any hesitation. You know, there's no regulation or anything. And then I think there's certain industries that there's some sort of regulation and restrictions, and they have to be careful about it. So anybody in the financial related industry, I mean, if you were applying for a job to be an insurance agent, they pull your credit just like that. If you were taking the test to become a mortgage loan officer, they'll pull your credit just like that. You know, so there's some industries where it's just automatic, and there's then there's other industries where there might be some regulation about it, and I'm not 100% sure about that. But yes, it is legal in general. Yeah.
Okay, good.
And more are doing it. That's the other thing to keep in mind. Yeah.
Yeah. Yeah. Self-employed, don't have to worry about that.
Yes.
Yeah. So surrounding the whole repair of credit, there are lots of myths about how long it takes to, get yourself out of trouble once you've, had some dings and messes on your credits. How long does it take, generally?
Well, yeah, generally. First of all, it depends on where the person's, coming from. I mean, obviously, I guess if they have a 500 credit score and they're trying to get up to a 650, or if they have a 600 credit score and trying to get up to 650, that's going to affect the time factor a lot, because trying to improve your score by 50 points versus 150 points is a pretty big difference time-wise. A lot of it has to do with what's on your credit report. If a lot of it's medical, or if a lot of it's late pays and things like that, rather than actual judgments or tax liens or bankruptcy, then those are going to be able to also see an increase in their score quicker. So what types of derogatories and negatives and problems you have on your credit report is going to dictate how long it's going to take to build it up. I mean, FICO has their algorithm, and that doesn't change. So my goal as a credit counselor, credit repair guy, is take all my understanding of FICO and credit scoring and the credit industry that I know, and look at a person's credit report and give it a customized kind of optimization of what can we do so that every month when FICO takes a snapshot of their data, that it's going to look better to FICO. And so that's how you do. And part of that may include getting some new lines of credit that you need to start building up, some new positive credit to counter the negative credit. The other thing last thing I guess I'll say about this, because I could go in this subject forever, but so that's what I do every day. But the other thing is there is a difference between if you kind of generally have always had low credit and now you're wanting to do something about it, versus at one time you had excellent credit and then something happened. Somebody went to the hospital, got sick, or you lost your job, or or the economy, like in the last 5 years. And then so you had a dip, and then now you're wanting to kind of go back to where you were before that dip. That's actually going to be easier to repair than if somebody has just never really had great credit, and then now they're ready to put up their bootstraps and do what it takes to build up good credit. It's actually going to be easier for the other situation than this latter one that I mentioned.
Okay. So I think also a lot of people get confused about bankruptcy and how it affects your credit, and the explain that to me. Bankruptcy, it's 7 years before it stops being reported on your credit, but it doesn't take you that long to recover.
Right.
How does that work?
Well, bankruptcy essentially is just giving you a fresh start, to be honest with you. You're in a way, not exactly, but in a way, it's kind of like you're 18 years old again and starting all over. The difference is that when you're 18 and starting fresh, you really are starting from ground zero. And so everything you do is not having to counteract anything negative, and it's all going to just be a positive impact. But bankruptcy is helping you start over, because when it clears out all your creditors and you deal with that, and you can start building new credit immediately. That's why it doesn't take necessarily 7 to 10 years, because immediately when you're discharged from bankruptcy, go out and get you a secured line of credit. Go out and get a CD secured loan. Do some things to get a new refrigerator at Conn's department store if you have to, appliance store. But go out and start building up some credit, and then eventually you'll have enough good credit to counteract the bankruptcy. So that's why it doesn't take, and it only takes a couple years. It really doesn't take 7 years. You can rebuild your credit after. I've seen people file bankruptcy and be back up to a 700 credit score in 2 years.
Good. That's good. Yeah. So there's this other idea that occasionally if I make a late payment, no big deal. Not really going to affect my score.
Yeah, that's kind of a myth too, and I guess that just comes from maybe not realizing what FICO does when it looks at your credit score. FICO looks at the most recent 24 months more than anything else. I mean, don't get me wrong. Don't think that something that's 25 months old doesn't have effect on your credit score, but it's going to emphasize the last 24 months more than anything. They don't know how to manage their credit, because that's what FICO really wants to look at, and that's what lenders want to see is, I loan you this money and you know how to make your payments on time. That's just the common sense lending. That's the big picture of lending. And if FICO sees that you have a 30-day late every now and then, it's gonna I mean, one 30-day late, your score will go down, but within 3 to 6 months it'll go back up. But if you do that sprinkled over the last 24 months, it's going to have a negative effect on your score.
Right. Okay, what about the topic? There's a lot of swirling around the topic of divorce, and a lot of people think that some things just automatically happen when you get divorced, and I think they probably run into a lot of damage from it afterwards. Like I heard the other day, the divorce decree will automatically sever our accounts.
Oh yeah, that is 100% myth. Most myths have a little bit of truth to them, but that's 100% wrong, because when you all that the lenders care about when you borrow money and when you do things on credit is whose Social Security number is attached to the account. So if you got something as a joint account, both of you got your name on there, and they have your Social Security number from both of you, and then you get a divorce, it doesn't matter if the judge now says the husband can have this car, and you can have this car. That's just a matter of who owns it now, like who has the title. But as far as the debt is concerned, if the other person's Social Security number is attached, and then this person who was awarded the car makes late payments, it's going to affect their credit score, the other person's credit score. And so the divorce decree absolutely means nothing to lenders from that perspective. Now, there is some things that I can do to help them build up their credit, and things that we can do to help them get out from under that responsibility, the obligation of that debt. But it's not automatic, and you have to do something about it. You have to be proactive about doing it.
Right. Okay.
And I actually advise people that if they know they're going through divorce, or they're going through divorce, is to actually talk to a credit counselor and maybe even their financial planner, and get some advice on how's the best way to mitigate the damage to their finances and their credit score and all that from divorce.
Yeah, that's really good advice. Yeah, because I'm sure there are so many things that they don't even know to ask.
That's right.
Right. So here's one. Once I have a late payment, there's nothing I can do about it.
In a way that is true. Okay, if you really were late, there's not much you can do about it, except there is still two things you can. So there's not much you can do about it, but there's a couple things you can do. First of all, if it's just happened like last month or 2 months ago, and I'm going to give away one little secret that I use all the time as a part of my business, and I don't mind giving away, because if that's all they're doing, then I'd rather them do it themselves. If it's one part of my whole process, then I'll do it. But if that's the only thing they need to do, I'd rather them just do it themselves. You can send a letter to the creditor, directly to the creditor, not to the credit bureaus, and it's called a goodwill letter. And if you have a 30-day late, you can actually send a letter and write it the right way. That's the only key, is you got to kind of write it the right way. And basically you're saying, hey, this one time I was late, I'm sorry, this is my circumstances, kind of a Dear John letter except for credit, instead of,
Yeah.
And so will you please, not report this 30-day late this one time or something like that. And that's called a goodwill letter, and you can do that, and you got a 50% chance. 50% is better than zero. You got a 50% chance that they're going to grant that. And I do that all the time for my clients. Another situation that could occur is that if you're 30 days late and it's been a while, a lot of times they'll report the dates incorrectly. They'll report the amounts incorrectly. I mean, you were still late, but then the way they're reporting it to the credit bureaus is incorrect. And part of the Fair Credit Reporting Act says that every consumer has the right to make sure that everything on the credit report is accurate, it's verifiable, and it's being reported in the right time constraints and dates and all that's related to it. So if you find out that you had a 30-day late a year ago, but then you pulled your credit report and that 30-day is now been 2 30-day late instead of 1, or that 30-day late says that it was late in one month when you really thought it was 3 months earlier, anything that could be wrong, you have the right to investigate that and it might come off, at that time. They might change it.
Good. That was going to be my next question, is if you do find that they've reported it wrong, there are things you can do. Right?
Yeah, there are things you can do. And again, if a person just has one account or one problem, I'd rather just do that themselves. And there are things that they can do. It's when you have a lot of accounts and a lot of different problems, and your credit report's just kind of messed up, or it's a really big technical issue where you'll need more professional guidance.
Right. Well, that's it for my myths that I had today. So, any last things you can think of that I haven't covered?
Well, let's see. Here's a very interesting myth, if you don't mind me just kind of bringing one up, is a lot of times when people related to divorce, well, the opposite of divorce, when people are getting married. I've had people come to me before they were getting married, and believe it or not, like one will have bad credit, one will have good credit, and they'll ask me, are our accounts going to be joined together when we get married, and will his bad credit now affect my good credit, and stuff like that. And the answer to that myth, to that question is no, it's not. Everything's completely separate. Don't worry about marrying somebody with bad credit, because well, now you might want to worry about somebody who has huge amount of debt. That's different.
Yeah, right.
Don't worry about credit scores. Just worry about how much debt they have. But as far as the score, it's not going to affect. They're not going to join together or affect each other. Again, it's separate based on each individual's Social Security number. Yeah.
Right. So we want to become one, but we can count on our credit not becoming one.
That's right.
Right. All right. Well, thank you so much again for speaking with us today and just answering a lot of these myths. I hope that a lot of you listeners, watchers, will find it really helpful. Again, Blair Warner from Upgrade My Credit, and I will have his contact information down below the video. There you go. Somewhere down there. And again, my name is Karen Highland. We're with the Highland Group. And if you are interested in a home purchase, then give us a call. Our information is down below too. Thanks again, Blair.
Hey, you're welcome. Bye-bye.
Bye.